Click the bell icon to get latest videos from Ekeeda.
Hello friends, we'll be going after certain basic accounting terms that we use in our day-to-day life when it comes to storing accounting information or when it comes to dealing with accounting information. Some of these accounting information or terms you must be aware of, and some of them will be very new for you. Let's start with it then. So the first part or the first term that we'll be learning today is entity. What do you know about entity? Entity is a certain thing which refers to having a special importance of its own. So when we talk about special importance of its own, it is different from any individual when it comes to accounting terminology. So a business setup which you have of your company is termed as an entity which has its separate legal existence. So entity is a completely different legal existence as compared to the individual owner or the individual director of the company. So a business might have a managing director, might have an owner, but business on itself stands and is looked after as an entity. So the managing director or the owner of the company is the caretaker of the company, is the person who looks after the company and not the company itself. So the individual has a separate legal existence as compared to the entity, as compared to the business. So this is what we defined entity as. So for example, if we give Tribhuvandas Bhimji Zaveri Jewelers, these are a separate different entity and the owners of this company are separate as compared to the business term. Hence, individual is an owner and is a different person as compared to the business. The different business that we have or the business that we have itself is known as the entity. The next term that we'll be learning after is transaction. When it comes to business, there are certain transactions. So what do you mean by transaction? Any receipt or payment of value or any cash receipt or credit receipt, any transaction or any amount or any nature of transaction that you do holds a certain value of monetary terms. This is known as a transaction. So if you make a transaction or if you make a purchase of 50,000, that purchase of 50,000 where you have paid cash and you have got goods in return, that is a transaction. So any exchange of money and goods between two or more parties or between two or more entities calls for a transaction. The third thing that we'll be going after is assets. So what do you mean by assets? Assets is the part of the company which shows the brightest side of the company. So when we talk about assets, assets are nothing but the long holding terms or the long holding assets or the long holding business parts that they have. So if the company owns a building where it functions, that building is the asset of that specific business. This asset is termed as long-term or short-term. So they can be classified into either long-term assets or short-term assets. So we have long-term assets which are more than 3 years, which will be used for a company for a long-term basis, which are also known as fixed assets. Current assets are something which are used less than 1 year. So anything above 1 year will be termed as fixed asset. Anything above less than 1 year will be termed as current asset. So these are the classifications that we have for assets. Now, the next part will be liabilities. As we have read assets, we'll be also going through liabilities. Liabilities is the part of the company which shows the credit standing of the company. As we have discussed earlier, that we need to have more of assets and less of liabilities to show a good credit standing. Similarly, if you have more of liabilities and less of assets, that means the credit standing of your company itself is low, which shows that the investors need to rethink about whether to invest in that company. The suppliers need to rethink about whether they really need to supply goods to your company, or the lenders really need to think about whether they are in the position to lend any amount to you because they don't have any responsibility or probably any confirmation that they will be getting the money back, as you have a lot of liability on your head right now. So liability is something which you have to pay off in the future years. It can be a short-term liability, it can be a long-term liability. Any liability which has to be paid off within a year, that is within 12 months, is termed as a short-term liability. Any liability which has to be paid off after 1 year or more than 1 year is known as a long-term liability. So if you have taken a loan of worth rupees 3 lakhs which has to be paid in 3 years, that is a long-term liability. And if you have taken a short-term liability which is like 50,000 has to be paid within 12 months or 6 months, that is a short-term liability. Next one will be capital. So capital is nothing but the amount that you have invested in your own firm or the organization that you run through, and the capital that is required, the self money that we have to invest in our own company, that is known as capital. Capital may be in form of cash, it may be in form of assets. You can get in the building, or if the building that is being run or the organization that you're running is itself in your own house or in your own building, that is the capital that you have brought in. Or if you're getting cash into your own business, that is the capital that you have gotten. Now, when we talk about capital, capital is always shown on the liabilities side of the balance sheet. So when you talk about balance sheet, you have liabilities side, you have asset side. Capital is always shown on the liability side and not on the asset side, despite the same amount being a part of your own. So these are certain terminologies that we have studied in the first part. We're studying few more terminologies in the second and the third part. Thank you for watching eKida. Keep subscribing to eKida.